Japan's yen just hit a 34-year low against the dollar. But here's what nobody tells you. This currency crash is already destroying retirement accounts across America right now. Your portfolio might be bleeding money, and you don't even know it. By the end of this video, you'll understand exactly how currency collapses ripple through your investments and what moves you need to make today. We're breaking down the yen weakness story that mainstream finance won't touch. Should you panic? Absolutely not. Should you act? Yes. Let's start with the brutal truth. When the yen weakens, Japanese exports become cheaper on the world market. That sounds good for Japan, right? Wrong. Here's why it matters to you personally. American companies that do business in Japan earn fewer dollars when they convert yen back home. Apple has massive operations in Japan. Toyota, Honda, Nissan all manufacture there. Sony, Nintendo, all of them report weaker earnings when currencies flip. Your mutual funds are loaded with these companies. Your index funds own them automatically. So when the yen drops 20%, those companies face real profit headwinds. That's the hidden tax on your portfolio. But here's the re-engagement moment you need to hear. The dollar just got stronger, and that's actually bad news for one specific investment category almost everyone owns. Do you know which one? The US dollar is crushing every other currency right now. The yen down 34 years, the euro struggling, the pound under pressure. When the dollar strengthens, here's what happens to your money. American companies that export overseas face serious headwinds. If you make widgets in Ohio and sell them in Europe, suddenly your prices are too high because your dollar costs more. That hits earnings. That hits stock prices. That hits your 401k. But hold on, dollar strength also creates massive winners. International bonds become dangerous. Foreign government debt pays less when converted back to dollars. Your bond allocation just got riskier. Insurance companies that operate globally face currency translation losses. Pharmaceutical firms with overseas revenue get squeezed. Tech companies that earn abroad in yen, euros, pounds all take haircuts. Now here's where it gets interesting for you. Some investors are making extraordinary returns right now by betting on currency movements themselves. Are you leaving that money on the table by ignoring Forex entirely? Most people think they own a diversified portfolio. They own US stocks, international stocks, some bonds, maybe real estate, but they're completely blind to currency exposure. Here's a concrete example. You own an emerging market fund. It looks diversified. India, Brazil, Mexico, South Korea. Solid companies with growth potential. Sounds smart on paper. Then the US dollar rallies 15% in 6 months. Suddenly that emerging market fund drops 20%, even if the actual companies inside got stronger. The currency killed your gains. That's pure currency risk eating your returns. Now flip the scenario. You own a total US stock market fund. Apple, Microsoft, Tesla, Nvidia, American companies. You think you have zero currency risk, right? Wrong again. Look deeper. Apple generates 46% of revenue overseas. Nvidia does 49% internationally. Microsoft is at 40%. When currencies weaken, these profits shrink on the consolidated statements. Your domestic portfolio is actually a massive currency bet without you realizing it. This is where most investors get blindsided. Should you abandon international investing because of currency risk? That's the wrong question. The real question is whether you're managing that risk intentionally or just hoping it works out. True portfolio diversification is not just about owning different asset classes. It's about intentional currency positioning. Here's what sophisticated investors do that you probably don't. They own assets denominated in strong currencies for safety. Swiss francs, Norwegian kroner, Australian dollars. Not as speculation but as ballast. When the dollar weakens someday, those holdings appreciate automatically. They provide portfolio insurance. Second, they actively manage currency exposure in their international holdings. Some international funds hedge currency risk. Some don't. The ones that don't are essentially making a bet that foreign currencies will strengthen. That might be good or bad depending on your risk tolerance. You need to know which funds you own. Third, they use foreign bonds and foreign dividend stocks strategically. When the dollar is strong like now, foreign bonds look unattractive, but they're actually cheap. Buying them now while they're out of favor gives you upside when sentiment changes. That's contrarian portfolio positioning. Fourth, They understand that currency diversification protects against political risk. If the US government faces instability, the dollar weakens. Having assets outside the dollar system provides insurance. You don't need much, maybe 10 to 15% of your portfolio, but that positioning has saved investors during every major crisis in the past 50 years. The question you should ask yourself right now is whether your current portfolio is positioned for a weaker dollar environment. Let's get tactical. What are professional portfolio managers actually doing right now with the yen collapsing? First, they're trimming exposure to multinational companies with heavy Japan operations. Companies like Costco, which has massive revenue from Japan, are seeing fund managers take positions down. Second, they're buying Japanese government bonds. This seems insane. The yen is weak. Why buy more yen exposure? Because Japanese bonds now yield 4% after being near zero for decades. That's attractive income. When the yen stabilizes, those bonds will appreciate too. Third, they're loading up on companies that benefit from yen weakness. Think luxury goods exporters. LVMH benefits when the yen is weak because Japanese consumers have less spending power and buy less luxury goods globally. Wait, that's backward. Actually, when the yen is weak, Japanese companies that export luxury goods become more competitive. Fourth, they're diversifying into other currencies quietly. Not flashy, not exciting. Just methodically building positions in Norwegian kroner bonds, Canadian dollar dividend stocks, Swiss franc holdings. These don't show up in year-to-date returns, but they're portfolio insurance. Fifth, they're buying currency ETFs outright. Dollar strength ETFs, yen weakness ETFs, direct Forex positions through managed accounts. The average retail investor has zero exposure here. The institutional money is already positioned. This creates an asymmetry. When this trade reverses, retail investors get crushed while professionals profit. What currency positioning do you have right now, intentional or otherwise? Here's what you need to remember. First, currency crashes affect every portfolio through hidden channels you probably don't see. Your blue-chip stocks, your index funds, your retirement accounts all have currency exposure whether you realize it or not. Second, true diversification means currency diversification. 10 to 15% of your portfolio should be positioned for dollar weakness through foreign bonds, foreign dividend stocks, or direct currency holdings. Third, the yen collapse is creating opportunities right now. Japanese bonds, yen exposure through select companies, and currency hedges are all available if you're intentional. Don't let passive portfolio drift leave you exposed. Take action this week. Audit your holdings for currency risk. Look at your international funds. Check whether they hedge currency or let it run. Consider adding 10% emerging market bonds as ballast. Subscribe to Wealth Pulse for daily breakdowns of currency movements, international investing opportunities, and portfolio positioning strategies you can use immediately. Your future wealth depends on decisions you make today.